Hi, I'm Michael McNair, Director of Investment Services at US Financial Services. First, I hope that you and your loved ones are staying safe and healthy. Today, I would like to share with you our thoughts on investments and how emotional decisions can have a negative impact on your portfolio. During periods of heightened stock market volatility, many investors are saving for retirement may want to move their money from stocks to safer investments, such as money market funds or high-quality short-term bond funds. This action is usually driven by the fear of losing capital, with no focus on the investor's time horizon and need for current liquidity. At US Financial Services, we remind our clients that it is important to keep long-term goals in mind. If you're saving for retirement, moving money from stocks to more conservative investments can be risky. That's because it is difficult, if not impossible, to know when to get back into stocks. If your timing is wrong and you miss the upswing, the value of your portfolio years from now may be significantly less than if you had stayed invested in the market. As an example, a hypothetical $1,000 investment in the S&P 500 index on January 1st, 1970 would have grown to more than $121,000 as of March 17th, 2020. If you missed the single best performing day over that period, the value decreases to a little less than $109,000, which represents a decline of more than $12,000 for missing one day out of 50 plus years. Miss the 5 best days, and the value falls to approximately $77,000, which is more than $44,000 less than if the money had remained invested. For an investor who has an intermediate to long-term time horizon of at least 7 years, stocks play a vital role in a portfolio by providing the potential for higher long-term returns, particularly at this time when fixed income yields so little. As previously mentioned, letting emotions drive the investor's actions by selling stocks during times of market and economic turmoil and deviating from a long-term plan can have a substantial negative impact on reaching retirement goals, requiring delaying retirement in order to rebuild sufficient savings. It is important to keep in mind that market volatility is a normal part of investing. Although stocks are riskier than other investments, they tend to perform better over the long run. And when saving for retirement, the long run is what matters most. At US Financial Services, we believe understanding the investor's risk tolerance, time horizon, and retirement goals allows us to develop the appropriate investment allocation so that when market corrections happen, emotions do not drive the investor's actions. I'm Michael McNair. Thank you for joining me today. Be well and stay safe.